Okay, welcome everybody to a special Wall Street Reporter Next Super Stock presentation. This video is actually being recorded a little bit before a very important news announcement from one of our favorite Next Super Stocks. And of course, for anybody that doesn't know, our goal is to bring you those stocks which have 10x to 100x upside potential. These are companies that are going after massive multi-billion-dollar market opportunities that are at a key inflection point in their growth, and there are multiple catalysts in place to unleash shareholder value. And we've seen that. We've already had 8-9 stocks that have increased between 1,100 and 5,000% over the last 20 months. And we're going to find out if this company is going to be the next 10 bagger. Speaking of catalysts, we have a new name which is going to be publicly announced. Matt, welcome.
Thanks a lot, Jack. Thanks for having me.
Of course, this is very early. I'm not going to say which date it is, but this is very early in the morning. So, Matt, let's get into
live on location.
Live on. This is actually live recorded.
Yeah.
So you're actually in the store. Which store are you in right now?
We're in one of our Junction location store located in the west end of Toronto.
West end of Toronto. Okay, so this is in the store, and of course behind you we have the CPG line, the future of butter, future of cheese.
Yep.
But of course, what everybody, unless somebody maybe didn't notice, we have a new name that is there, Oragin Foods Inc. Matt, what is the deal with this name change?
Jack, really excited to be on today. This is what I think is a major milestone in kind of where the company is going. So we have rebranded the parent company, the public company, to Oragin Foods Inc. From Organic Garage. And what we've done is we've restructured the company into two divisions. We have a CPG division and we have a retail division. And so, been on the program before and discussed, the exciting acquisition we made kind of early last year, Future of Cheese. So the Future of Cheese will be in our CPG division. And then we have the Organic Garage retail business in our retail division. And we're really doing this because we really want to unlock the value potential in the company for our shareholders. We see an absolute ton of potential on the CPG side. We spend a lot of time, evaluating and growing Future of Cheese. I mentioned previously on interviews with you, we're taking a very serious look at the U.S. market. And because of kind of some of those things that we've been working on, we felt this is a great strategic move to not only benefit our retail division as we're looking to grow up, but definitely the CPG side, given the opportunity that exists in the market and what we have kind of in the pipeline, not only with Future of Cheese, but potential acquisitions down the road. So this is a very, very exciting milestone.
Okay, so I think also I would call this a very important catalyst. I mean,
yeah,
this is really when sometimes people say, oh, a catalyst. This is a real catalyst to unleash massive value, and here's why. Because we've seen you have a core business, which is the retail stores. You have 4 stores right now, 30 million in revenues. We're going to talk more later about the idea is to basically double that this year. You're going to open 4 to 6 new stores. But meanwhile, you have this the business you've launched, which is Future of Cheese, which is the CPG, the plant-based foods line. We've seen I don't know how many. There's probably a dozen companies right now in the plant-based that are trading at massive valuations, 30, 40, 50, 100, and these are microcaps, by the way, 50 million plus valuations. They have very little in the way of revenues, very little in the way of traction as you have here. Basically what we're doing here is we're unlocking value, because now you're going to have essentially the CPG line potentially being valued separately. At some point, you have the retail brands. So this is I think this is going to be very valuable. At some point, though, are you going to spin out the CPG line or sell it?
Well, Jack, part of this restructuring gives us just an absolute ton of options. So, treating them as divisions allows us to potentially spin out if we want. It's easier to acquire and sell assets within each of the divisions. Allows us to add some management muscle to the division, which we're very excited. We should have some good press releases coming up in the future. We want to add some management expertise as we're looking at entering the U.S. market. And really, it comes down to is we've just been blown away by the response from Future of Cheese and the initial launch of the products. And so through our kind of evaluating next steps for the company and really wanting to reach the full potential of the brand, we just felt that this was a great strategic move for the company to unlock the potential in the CPG division and the retail division, but specifically the CPG division. It's easier to present the company to potential retailers when it is a kind of a separate division in our company rather than, a quote unquote organic garage brand.
It was a little bit confusing. It was a little bit confusing before.
Yeah, we feel it streamlines the communication and the story. It makes it a much more compelling story to the public markets and the shareholders. We feel that there's a lot of potential on the M&A side as companies continue to kind of inquire with us based on what they've seen with the Future of Cheese business. And so we just feel that you're right. This is a major catalyst. I discussed the 4 previous catalysts that we felt that we were going to be working on this year. There's been a lot of stuff going on behind the scenes that I'm super excited about. This is one of those major catalysts. And we look forward to kind of the next ones coming up that we're excited to announce. But this was a major one for us. Should be very exciting for existing shareholders, new people looking at the company in terms of what we're going to be able to do now with this kind of restructuring.
Okay. Yeah. So I think it's definitely a game changer. One of the things also, of course, it allows you to do is it allows from an operational standpoint, it allows you to focus. In other words, you can bring in people who, management, et cetera, where their interests, their incentives are going to be aligned purely with that business. So they're, on the CPG side, and of course the retail side is, so that way it's very important from an operational standpoint. You have the focus. At some point, of course, now that you have these 2 divisions, the market is going to clearly understand and maybe be able to extrapolate that at some point there's a potential for a spin out, a potential for this business to be valued separate. It makes it much more transparent. I think it really adds a lot of value. Okay, so let's get into the exciting part about the upside for the CPG business now that it's a separate division inside of Oragin Foods. Now, So the CPG, what is that going to be called? The CPG business?
It's not necessarily called anything. It's just a 2 distinct divisions within Oragin Foods. And look, for all of those, the word origin, I'm sure I don't have to explain, but it's kind of the beginning of everything. And so we felt that it was a really compelling name with what's going on with the brands that we're acquiring in terms of being leaders in their fields, and other brands that we're looking to potentially acquire down the road. So we felt it was a great name. It's a memorable name. And so within Oragin Foods, we have these 2 distinct divisions. It's just a CPG division and a retail division. They don't have specific names, but those are the 2 that spiral out of the main parent company. And within the CPG division, you will have multiple brands, Future of Cheese being one of them. And as we look at growing that division, we're going to be looking at potential acquisitions in not only the plant-based space, but just the overall organic and wellness space, just because we see so much potential. And it goes back to, Jack, something that we talked about very early on is the benefits of having, somebody like us, involved in a company like this being a retail business is we get to see brands at their very beginning. And so we're at their origin. Yeah, basically. And so what it allows us to do is see brands before they get too big to potentially look at acquiring them. And so it gives us a unique insight into what's going on in the market. And as brands have seen what we've done with Future of Cheese and what we're doing overall as a company, we have brands inquiring with us about, our interest in their brand. Is it something that we'd be looking at working together with them? So we just felt that there's so much potential on the CPG side. And Jack, you said it, CPG brands are valued much differently than a bricks and mortar retail business. The multiples are much higher. It allows us to provide much more enhanced value to our shareholders in terms of, just the overall value of the company and how that translates to share price. It gives us access to a news flow that is super exciting. And so, there's just so much upside with this change that, we're so excited.
Okay, so one of the of course, as you said, the big benefit. I think for the way investors see it, or I'm sure the way you see it, is that with this. So Organic Garage, that brand stays the same. The stores, Organic Garage, nothing changed.
That's under our retail division, yes.
Okay, so organic, and then of course that's organic food at low prices.
Yep, bricks and mortar, organic, all natural foods at everyday low prices,
30 million
providing
in
value.
sales right now, 4 stores.
Great base, yes.
Okay, expanding to we'll talk about that a little bit later. But okay, the CPG side. Okay, so this is the exciting part. So you're not going to just stay with Future of Butter, Future of Cheese. You're going to acquire other organic plant-based brands.
Well, it allows us to put a management team in place, which, we're hopeful we're going to have a few announcements coming up in the near future that help clearly outline that. We have certain steps that we're going through. This is the first step, but there's plenty more good news coming. But yes, and the management team will be tasked with going to market and evaluating opportunities to potentially acquire businesses that fit within our CPG division. We feel a lot of merit in grouping companies together. They share resources. It's more efficient. It's more cost efficient for the brands to be able to work together. Some of the brands will share even ingredient profiles, so it allows us to buy better. There's just so much potential in grouping like-minded companies together. And once again, because we're seeing things from our retail division, at their very beginning, and we're at the ground floor, and brands are always pitching to us, we're getting to see things before they become too large to potentially maybe acquire or too costly to acquire. So it gives us unique insight into the industry that we feel we can add a lot of value to these companies by grouping them together in our CPG division.
Okay, so there's actually massive synergies. There's when you do I don't want to say a consolidation or but really in this plant-based business, there's a lot of new brands popping up, and the reality is there's a lot of economies of scale, a lot of synergies in terms of distribution, getting into doors, et cetera, when you're part of a group, which is kind of the way the CPG brands started 100 years ago with I don't know whether it's Campbell's Soup or Unilever, whatever the brands are, but we saw consumer brands get rolled up, and this is happening now in the plant-based organic space, or it's going to start to happen.
Well, it's going to start. You're seeing some companies come out and looking to consolidate brands into, almost like a quasi conglomerate. You look at the Unilevers, you look at the Johnson and Johnsons, you look at the Procter and Gamble's, you look at the Danons. They all have a host of brands within their portfolio, and they're able to pitch those brands to retailers. And then there's shared costs that make it more efficient for these brands to be promoted, to be produced. And so we feel there's some opportunity there. We have a very strong board that has experience in the CPG side of the business. We have some exciting announcements to our management team that we feel, are going to be very well received in the near future. And the goal is, yes, to look for like-minded companies, group them together. It's easier to pitch to retailers, including even like myself. When I sit down with brands that own multiple brands, companies that own multiple brands, they pitch their portfolio. It's not just one brand. So we just feel that this helps set us up for the future, for what we want to do as a company, going forward. And, we just feel like it's just a tremendous opportunity that exists in the market.
It makes a lot of sense, because now you could, of course, because you're going to have a separate division. So even when you do M&A, it's not as dilutive. Because you can do all sorts of structuring, etc. So it all stays in one thing, and of course, the synergies are great, because again, Future of Cheese, Future of Butter. Okay, so let's say you get the 10 SKUs, it's great, but now if you can have some synergistic type of products, so when you go to distributors, now you have 30, 40 SKUs, you have a portfolio. They look at you in a completely different way. These guys are here to stay. This is somebody, it's and they may not want to buy one thing, but they'll buy the other, or vice versa. It's the same.
Well, Jack, and we talked about the verticals. We're in the plant-based, butter and cheese space. You have the plant-based yogurt space. You have the plant-based milk space. You have the plant-based meat space. You have the plant-based snack space. I mean, there are so many like-minded categories and verticals out there for us to access now that we've restructured and have this kind of formalized way of looking at and evaluating businesses and how they fit into our overall corporate structure. it goes back to the main point is this is unlocking a tremendous amount of value for the future for our shareholders in terms of what we're going to be able to do with the business. So like you said, it is a major catalyst for the start of the year. And, we're very excited for what this means for the future.
But now, Matt, there's actually a couple of catalysts right this year. I mean, Origin Brands, let me just pop this out, the new name, Origin Brands is actually chock full of catalysts. I mean, there's really some major things right now inside this story, which any one of them, I think, I told before, well, I see, again, it's not you saying, but I really believe that this could be a $2.50 stock, even a $5 stock potentially in the next 6-12 months, as the value gets unlocked and you have the new. So let's go through some of these items, some of these catalysts. Number one, most obvious is M&A activity inside of the CPG business. You're going to be buying other synergistic brands. Okay, so that's
absolutely. So we're definitely going to be out there in the market. We're going to be looking and evaluating brands that fit our mandate and are cost sensitive. We're not looking at doing anything dramatic, but we do feel that we have an insight into brands at a very early stage that if we plug them into kind of our model and what we're developing, that we can scale them much quicker than they can do on their own and independently. So absolutely, M&A and activity is something that we're definitely looking at.
Matt, you make a very important point, which we've talked about, but I think people really need to understand this, is that, there's a lot of people in the plant-based space in terms of the microcap stocks. And, a lot of these guys, last year they were doing mining, they were doing cannabis. Now they're doing what flavor of the month, whatever it is. And even people who are in the business, people who might be doing plant-based foods or organic foods or CPG all their life, but they're looking at it from a very kind of narrow perspective, whereas because you operate 4 stores, you're selling $30 million worth of product across thousands of different SKUs, you have insight into what moves on shelves. Essentially, Organic Garage, the stores, is sort of like the Netflix of plant-based foods, because what gave Netflix so much power early on is that they were able to get a lot of data into who was watching which movies, what was the demographic, and they were able to model things to understand, okay, this is the type of movie that is going to work. This is not going to work. We're willing to put $10 million or $100 million into this project because we know that there is already a population of X, Y, and Z who's going to watch this.
Well, Jack, in essence, we are a vertically integrated company, so we are able to get the brands and products we acquire onto retailer shelves, starting with Organic Garage. Given that we are vertically integrated, we're able to use that information and data not only to provide critical insight to the brand and how they adjust, could be flavor profiles, ingredient profiles, cost profiles, packaging profiles, but then we're able to use that information and how we present to other retailers for the brand. And having that insight into whether it be turns on shelf and things like that valuable market insight provides additional, reasons and examples and information to prospective new retailers on why they should be listing the brands. And so that sort of insight is golden. If you were to ask brands, that sort of information and what that means to them and how they craft the direction of their business, it's invaluable. And a lot of brands, just to be clear, spend tens of thousands of dollars just to get some of that insight. They have to pay for data to be able to understand where their brand sits and how their brand turns and how their brand is evaluated when we have all that information in-house. So it's, we are in essence a vertically integrated company, which is a unique perspective for potential brands we're looking at acquiring, and a definitely added benefit, for them when they're speaking with us.
Yeah. So essentially, so you're really like the Netflix of organic foods, plant-based foods, because you have the stores, you have your own products, and of course you sell other people's. I mean, Netflix, shows movies from wherever. Now, at some point, I think some people are going to say, okay, there is going to be maybe some potential conflict because just like you have Disney Plus, you have people like to keep some things or whatever in their own silo or made, but because Organic Garage, the retail stores, is really such a small player in terms of the massive, I don't know, it's $1 trillion retail store market. No one's going to say, oh, because they're not going to, I mean, especially when you go into the US market. I mean, like, they're not going to say, oh, well, this is a competitor or whatever. That's not going to be an issue.
There's no conflict. And look, this goes back to why this is such a strategic move with two independent divisions. The CPG division stands on its own. The organic garage business and the retail division stands on its own. There are cross synergies and benefits, but it is not all organic garage based from a public markets perspective where, like you said, whether it be businesses or shareholders or prospective investors, it can be confusing. The stories, might be confusing to navigate. This streamlines a lot. It separates things, which is a benefit, but also there's a common link to provide, benefits when we need it to. And so it's why it's just it's a great strategic move.
No, listen again. This is like the Netflix of organic food here. All right, so there's I think there's at least 4 major catalysts which I want to go through. So we covered the M&A side where you're going to be making acquisitions, and I'll talk to you later about if you're looking at anything in the pipeline, etc. I mean, in theory, you could do $100 million worth of M&A in tomorrow. In theory, I mean, potentially.
Yeah, I mean, look, we're going to be selective when we're evaluating. This is the start of the process in terms of us, strategically structuring everything. But you're right. I mean, there's lots of companies out there, and a lot of companies that are seeing the benefit of what we're doing. So absolutely.
Okay, so you got the M&A side now. Catalyst number 2 is related to the CPG side. Is distribution deals, expansion into the U.S. market. This is what everybody's waiting for. Is one is Origin Brands, Organic Garage. Everybody can expand into the U.S. market. So I think what we're waiting. So especially now that you're going to have other CPG stuff So I think that's something which I think we're going to be seeing some announcements on, whether it's co-packers which make the stuff, whether it's distribution, etc. Well, there's a lot of possibilities for distribution.
There's a lot of possibilities, and this goes back to people can read through the lines. There's a reason why we're doing this restructuring, because there's a lot of stuff happening behind the scenes. When it comes to us looking at entering the U.S. market, what is the story we want to tell when we're in the U.S. market? And so we feel, once again, we were overwhelmed by the response, specifically by a lot of U.S. customers inquiring about where they can find the future of cheese products. So we know the potential in the market. We said that there was major catalysts that we were working on this year, which was SKU development, signing on a co-packer, signing on a national distributor, and then reaching 500 to 1,000 doors this year. And so there's been a lot of stuff going on with that, which is exciting. But yes, those are all major catalysts on the future of cheese side within our CPG division.
Okay, so in terms of distribution, and we went through some numbers before, but at that point we're only talking about distribution for future cheese, where you said, okay, when we're in 500 doors, here's X amount that we can generate with 10 SKUs. When we're in 1,000 doors, it's X, and of course. And I think the number was like 15, 25 million. And we were talking about like something.
500 doors with 10 SKUs, turning 1 case per SKU per week per door, with a $5 average unit cost to the distributor. That is a $7.8 million a year business at 500 doors.
Okay.
Go to 1,000 doors. Again, go to 1,000 doors. You're right. You're at 15, 16 million. Okay. Go to 2,000 doors. Go to 4,000 doors. Yeah. So yeah, it's just a multiple.
And just in case anybody doesn't know, is we're talking about Oatly is in 90,000 doors, right? So
in a lot.
There's like 100,000. I mean, I don't know, there might be 1 million retail stores in the U.S. But really, the number is, if you're in 2,000 stores, I think that'll be very, very good in the next 12 months. So $15 million if you're in 1,000 stores just with Future of Cheese. Now, if you pick up a couple of more products, let's say you get another 10 SKUs, whether it's you buy 2 different brands, 5 SKUs each, or whatever it is. Now, all of a sudden you could be at 100 million very easily.
Well, things can grow very quickly. Absolutely.
Very exponentially. I mean, you can grow exponentially at that point.
Well, yeah. I mean, the sky's the limit, which is why, going back to the point of doing this restructuring, it allows us to unlock the potential within the CPG side of our business to scale it. You're right, to an unlimited potential if that's what we choose. I mean, there's no limit in terms of what we can do. within that CPG division with the way things are structured now and what we're working on going forward. So yeah, it's just the sky's the limit.
Especially, at some point, I'm assuming that, the CPG business is going to be spun off or something. So then you're going to have much more flexibility in structuring deals because it'll be,
Well, it can be spun off. And just going back to the point, it becomes much easier to, once again, not only acquire businesses and fit within the division, but also sell businesses within the division. You're not selling a whole company, you're selling a small piece. And you look at all the Unilevers, the Procter & Gambles, the Johnson & Johnsons, the Danons, they all buy and sell brands within their, consumer packaged goods divisions.
Yeah, they sell to each other. This private equity firm is the. I mean, there's just a constant trading of brands.
Yes, and so that potential becomes part of this kind of structure that allows us that freedom and flexibility to do something very similar.
Okay, so we talked about catalyst 1, M&A. Catalyst number 2, distribution. Catalyst number 3, I want to talk about is new store openings, which is, again, you have 4 stores you're doing on about 30 million run rate or so. And you talked about how many you have. You basically you have Savills, which is the
global real estate company. Yes.
Commercial real estate company is basically
global.
Getting you locations, and you talk about getting 4, possibly 6 new stores just in Toronto for this year.
Yeah, well, we felt once again, coming out of COVID, that the real estate market afforded opportunities for us, especially with our kind of revised smaller footprint model in this 10,500 square foot range, and transitioning out of our centralized distribution model to a decentralized distribution model allowed us the opportunity to access all of Ontario when it came to evaluating new sites. And so our real estate team has been hard at work, evaluating sites. There's a couple times, Jack, where I've been able to be on calls with you because I'm out doing site tours. So it's very exciting. We do feel that there is an opportunity within our retail division, which houses Organic Garage, to grow Organic Garage, and 4 to 6 stores would more than double the company, in terms of that retail division side. And, we're working towards, having some announcements this year to clearly outline kind of that run rate path to getting to that 8 to 10 store range, very soon. So yes, absolutely.
So of course, if you let's say come out of 2022 with 8 stores, just and again, you talked before about opening 4 stores at once, and you kind of went through all the math of why it could be done. It's not like a big deal. Oh my God, because once you have the model in place, you can easily scale up. Just like we see, I don't know, Starbucks, Chipotle, whatever it is, they open up 100 stores at once. I mean, it's once you have the model, it's not a big deal.
Yeah.
Absolutely. The first store is the hard part. Okay, so basically you could do 4 at once, and I think there could be an announcement, like I don't know, might happen next week. I mean, or next month, where you're going to say, hey, we signed 4 leases. We're starting construction, whatever, in April, May. We're going to have 8 stores. Now you're going to be exiting 22 with 50 million plus revenues run rate in the retail stores, and that alone. I mean, we can go through multiples, valuation, comps, but if I think the market pays for fast growth, and if you're able to show that you can grow, you can scale fast, you can get 4x revenues for the stores. That's 200 million plus right there, which is the equivalent of $4 a share on the stock price today, right? And plus you have the CPG story, which that's blue sky potential. Yep. I mean, the CPG side could be worth 10x revenues, and because especially if you could do M&A, so that gives people a lot of blue sky. That's why I think the stock could be worth $5 plus. I know people laugh at that, but they've also laughed at some of our previous stocks, which are scrolling below on the bottom of the screen, where hey, nobody believed that these things could go up 10x, 20x, 50x, whatever it is. But again, just like you're the Netflix of organic foods. You have insight into what works. Wall Street Reporter is kind of like the Netflix of stocks. We have an understanding of what works.
Yeah.
What the possibilities are based on a lot of data.